In this video, we're going to look at how gold competes with other currencies, and we're going to look at what factors make holding gold relatively more or less attractive compared to other currencies in the world. So we're going to use the example from our previous video, and we're going to assume that there are only three currencies in the world: the US dollar, gold, and rest of the world currencies. Now, if you watched our previous videos, you know that the reason that we're treating gold as a currency is because a lot of people who hold gold or demand gold look at it as a store of wealth or a store of value. And because of that, they often compare gold to other currencies when they're trying to decide how to keep their wealth. We're also going to assume that the exchange rate between US dollars and gold is that 1 unit of gold is equal to 1,000 US dollars. And as we talked about before, because gold is denominated in US dollars, this exchange rate is the price of gold that you see in any market. We're also going to assume that the exchange rate between US dollars and rest of the world currency is such that 1 US dollar is equal to 2 rest of the world currencies. And finally, we know from the previous videos that defining these two exchange rates defines a third exchange rate between gold and rest of the world currency, such that 1 unit of gold is equal to 2,000 rest of the world currencies. Now let's ask ourselves the following question. If you're sitting in the US, what makes it attractive to hold US dollars? One way to answer that question is to think, well, if I'm holding US dollars, so the safest thing that I can do with my US dollar is that I can buy a government bond with it. Now, when you buy a government bond, you earn an interest rate that depends upon what the interest rate is in the economy. So one way to answer the question of how attractive is it to hold US dollars is to say, well, the interest rate in the US is now 5%. Meaning you can buy, let's say, a 3-year government bond that will pay you 5% a year to just keep your money there. Now, someone might look at that 5% and might think, wait a second, that doesn't capture the entire picture. So let's imagine that we have $100 and we put it in a 3-year government bond that pays you 5% every year. So at the end of 1 year, we have $100 that we put into the bond plus the 5% interest that we've earned. So we've got $105. Now these $105 1 year later might not be worth the same as $105 the year before. And the reason they might not be worth the same is because you might be able to buy less with those $105 a year later. And the reason why might be because the price level in the economy might have gone up. So let's say the price level in the economy went up by 1%. That means that the same amount of money a year later can buy 1% less goods and services. So we're going to define a term up here, and I'm just going to write that the real interest rate is equal to the nominal interest rate, and the nominal interest rate is this 5% over here that the bond pays you back, minus the inflation rate, which in this case was the 1% that the price level was increasing by on a yearly basis. So in our example, the nominal interest rate was 5%, the inflation rate was 1%, and the real interest rate, which is equal to 5 minus 1, which is 4%. Okay, so now we think that this 4% real interest rate captures the attractiveness of holding money in US dollars. So let's go ahead and think about how attractive each of these other two currencies are by the same metrics. The first thing I'm going to do is just clear some stuff. Alright, so I just cleared some stuff and then added these labels for each currency. So let's just assume that the nominal interest rate in the rest of the world is on average 6%, and that the inflation rate is also 1%, and that implies a real interest rate of 5%, or 6% minus 1%. So now let's think, what should the nominal interest rate be for gold? When you buy gold, you can't then take that gold and invest it in anything. All you can really do with that gold is just have it sitting around somewhere. And so we're going to assume that the nominal interest rate for gold is 0%. In reality, it's probably slightly negative because you actually have to pay money to store gold, but we're just going to ignore that for now. The next question is, what should the inflation rate for gold be? And when you think about it, what makes logical sense is to assume that the inflation rate is equal to how much new gold is brought into the whole gold market or gold ecosystem every year. And so we know from our previous video that there are 2,600 tons of gold that are brought into the gold market every year by miners, and that there's about 165,000 tons of gold in the market today. Now, when you divide these two numbers, you get about 1.5%. And so what that means is that in a given year, there's 1.5% more gold than there was the previous year. And so that's a measure of how less valuable your gold will become every year. And so for the inflation rate, I'm going to write 1.5%. And this implies that the real interest rate on gold is negative 1.5%. The 0% minus the 1.5% inflation rate gives you negative 1.5. So now let's imagine that you're sitting in the US and you're thinking, well, I can earn a 4% real interest rate by just having my money sit in government bonds in the US, or I can invest it in government bonds abroad and earn 5%, or I can buy gold and earn negative 1.5%. And so in this scenario over here, it's not particularly attractive to buy gold, because you can make a higher return by having your money sit in the US in government bonds. However, if the economic situation in the US changes such that the nominal interest rate is equal to 0%, the inflation rate is equal to 5%, and the real interest rate is equal to negative 5%, and similarly in the rest of the world, the nominal interest rate is also 0%, the inflation rate is also, let's say, 4%, and the real interest rate is negative 4%, then in this scenario, you'll notice that gold starts looking a lot more attractive. And so in a scenario where the real interest rate gets lower and lower, gold seems like a more and more attractive way to store the value of the money that you've earned. So in this case, where the real interest rate across the world is negative 5%, you'd expect a lot of money from the US and the rest of the world to go into buying gold. And all this money flowing into buying gold would likely change this exchange rate between gold and the US dollar. And it might change it so that 1 unit of gold then becomes equal to 1,500 US dollars. And so what you might expect to see historically is a relationship between the real interest rate in currencies and the price of gold. And in this chart in front of you, I'm showing you the price of gold in US dollars, which is the pink line that you see over here. And in the blue line is the real interest rate in the US. Now, I've excluded the real interest rate in the rest of the world, partly just to keep things simple, and partly because people generally perceive the US dollar as being more safe than rest of the world currencies, and so that line or that graph isn't quite as important. I've also highlighted with this green line over here where the real interest rate is about negative 1.5%, which is about over here. And this negative 1.5% is what we're assuming is the inflation rate of gold. And so our hypothesis is when the real interest rate in currencies approaches the real interest rate in gold, people will start seeing gold as an alternative to their currencies. And so we see here where the blue line is less than negative 1.5%, we see gold rally. And again here, where the real interest rate hits about negative 7%, we see another gold rally. And again, over here, where we see the real interest rate get close to 0, we see the price of gold go up a little bit. And over here, where we see the real interest rate in the US being very close to negative 1.5, we see gold rallying. And again, over here, in the last 4 or 5 years, where we see low real interest rates, we see the price of gold increase. And so the big picture here is that the price of gold might be related to the attractiveness of keeping money in other currencies. And so when you go out and you buy gold, you are effectively betting that keeping money in other currencies will be increasingly unattractive.